After President Richard Nixon took our dollar off of the gold standard in 1971, money, or what we call money, was never the same. Since then, we have seen a massive amount of inflation, which makes savers losers, especially in a low interest rate environment. What's up, everybody? I am Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. Between 1913 and now, $1 has lost just over 96% of its buying power. And between 1971 and now, our dollars have lost right around 85% of their purchasing power. That means that $1 in today's time has the same buying power as 4 cents back in 1913, and $1 in today's time has the same buying power as 15 cents back in 1971. This trend is bad news for savers because your savings aren't growing. Your savings just sit there, they stay flat while the price of everything else around you keeps getting more expensive. But it's good news for investors and the financially educated who own the assets, because as dollars become more and more diluted, asset prices keep going up. We are in a very low interest rate environment right now, which means if you put your money in the bank, if you take $1,000 and you put it in the bank, after 1 year, you're gonna have $1,000. Back in the day, if you put $1,000 in the bank, you might be able to get a 2% return on your money, or a 5% return on your money, maybe even a 10% return on your money, depending on how far back in time you go. But nowadays, we are in an environment where banks pay you nothing. When you deposit your cash in the bank is going to take this cash, they're going to lend it out to somebody else, and they're going to charge 3, 4, 5, maybe 15% a year in interest, depending on what kind of loans they make, whether it's a mortgage or a credit card. So the bank is making money off of your deposits, and in return, they pay you nothing. The majority of people assume that keeping your money in the bank is a safe investment, because when you keep your cash in the bank, it's protected. It's safe. You have $1,000 in the bank today, and if you go there tomorrow, you know that you're going to have $1,000. And even if something really bad happened, you're protected with FDIC, which insures your investments, your bank deposits up to $250,000. So even if something happened to the bank, your money is still safe. You still have the cash that you can access. The only problem with that is a lot of times these safe investments end up being the most risky investments. Because yeah, if you put $1,000 in the bank today, you'll be able to access this $1,000 tomorrow or a year from now. The only problem is that $1,000 investment or saving, whatever you want to call it, in the bank is a guaranteed losing investment, because every single day that money sits in your bank account, it's losing buying power and it's losing value thanks to inflation, because you have $1,000 in the bank, but things that cost $1,000 today are not going to cost $1,000 in a year, and they're not going to cost $1,000 in 5 years or 10 years. They're going to get more and more expensive, while the $1,000 that you have in the bank is just going to sit there and stay at $1,000. I grew up in a saving heavy household. My parents are immigrants from a state in India called Punjab, and people who come from the traditional Indian culture have this save first mindset. And so my parents always told me that if I wanted to become successful, I had to study hard in school, become a doctor, and when I became a doctor, I'd make a big salary, which meant I could save a whole lot of money. So the whole plan that I had before I started learning about financial education was make a big salary and then save as much money as possible. The problem with that is your savings are losing investments. You can never become wealthy by saving your money, because your savings are guaranteed to lose value. Cash is a liability in an inflationary environment, because your cash sits there flat while the price of everything else keeps going up. One of the reasons we saw such a big drop in the value of our dollars after 1971 was because in 1971, President Richard Nixon took the United States dollar off of the gold standard. Prior to 1971, the value that each dollar had depended on how much gold we had as a country. But then the United States government started running into some economic issues, so that's when President Richard Nixon took the dollar off of the gold standard. So they stopped the connection between gold and the dollar essentially just became pieces of paper that now the government, with the help of the Federal Reserve Bank, could print on demand. This is great news for the wealthy and the financially educated, because now all these new dollars were being printed and entering our economic circulation. And where does this money go? Well, you can kind of think of it like a stimulus check. Let's just assume that a whole bunch of people get a brand new $1,000 check in the mail. What are they going to do? most people are not going to save it and invest the money. Most people are going to take this money and they're going to go out and they're going to go shopping. So now when they go shopping, now the business owners make money and the investors make money because the businesses make bigger profits. And when the businesses make bigger profits, so do the investors. So as more and more money gets printed, this money flows to the top, which makes the rich richer and it makes the poor poorer, because now the poor might have a smaller amount of dollars, but even if they had the same amount of dollars as before, the amount of dollars relative to all the dollars out there are smaller, which means each dollar is worth less. So even if you have the same amount of dollars as before, each dollar doesn't have as much buying power, so you're effectively poorer than before because of all this inflation. That's why inflation is known as the hidden tax, because it makes the people who are unaware poorer without you even knowing about it. Ever since 1971, the United States government has been working with the Federal Reserve Bank to print money and inject this money into the economy to help the economy grow quicker. Now, this works as long as people are happy working for this kind of paper money, fake money. But if people ever realize that, hey, we're not happy working for this fake money, we want real money, that's when you run into issues. This is the same issue that has caused so many empires to collapse in history. The Roman Empire, the Weimar Republic. You saw the same thing happen in Venezuela in 2017 and 2018. If people are not happy with the paper dollars that they're receiving and they want real money, then that's when you run into economic crisis. Now, the topic for today's video is not hyperinflation or the long-term effect of money printing. It's understanding the importance of saving your money and saving your money the right way, the smart way, instead of being the person that's just saving your money, hoping that your savings are gonna become wealthy, because one of the biggest lies that are told to people is that you can save your way to wealth. Saving your way to wealth is kind of like taking an escalator to go up a flight of stairs, except the escalator is not going up, it's going down. So now you have to fight the escalator to go up. Not only do you have to go upstairs, but now you have to fight the current of the escalator to go up the stairs. I save money for only 3 purposes. I do not save money hoping that my savings are gonna make me wealthy. I have a reason for why I save money, and it has to fit into one of these 3 reasons. The first reason why I save money is to save money for emergencies. I look at my savings kind of like a cushion to protect me from an emergency. If my car breaks down, if something happens to my house, if something happens to my wife, then I want to have some cash that I can fall back on. That way I know that, hey, I don't got to worry about ever going into debt. I have this cash sitting there so I can take care of whatever emergency might come my way. You want to have somewhere between 3 and 12 months worth of expenses sitting in a savings account that is liquid, that you can access anytime, because now this is money that you have that you don't have to worry about going into debt for. This is cash that you have for an emergency. But after you have this emergency savings account filled, again, somewhere between 3 to 12 months worth of expenses, depending on your risk tolerance. If you're okay taking on more risks, then maybe around 3 months worth of expenses. If you don't like risk, then somewhere around 12 months worth of expenses. But you want to take this cash, put it in a savings account, put it in an account somewhere that you can easily access. And once you hit your savings goal, you don't want to save any more money in this account unless your expenses really go up. But unless your expenses keep going up, you do not want to save more money into the savings account. You just want to let this cash sit there. So think of it kind of like a glass of water. Once you fill up the glass of water, your savings are full. You don't need to put any more water in your glass. And in this case, you don't need to put any more savings in your emergency account. So you need to have this emergency account to protect you from a financial emergency. This is not money that you're using to make you wealthy. This is not money that you're using to buy a TV when it goes on sale. This is not money that you're going to use for a down payment on your home. This is extra cash just sitting there to protect you against the worst case scenario type of situation. Second reason why I save cash is to save money for my purchases. So I use cash to obviously pay my bills, and then if I want to buy something, if I want to buy a car, if I want to buy a home, this is cash that I need to have aside. So I will save money for a big purchase or a smaller purchase. So I'll save cash or put aside cash, that way I have the money to do that. And the third reason why I save money is to make an investment. This is the biggest reason why I save cash, and this is money that I have in a bank account that I know is going to be invested. I don't want you to think that as soon as you have some extra cash, you have to invest it in the market today, or you have to use it to buy something today. You just need to understand that this is money that needs to be invested. So I have a separate bank account where my cash for my investments go, and this money sits there until a deal comes my way. Maybe I'm looking for a good stock deal. Maybe I'm looking for a business to buy. Maybe I'm looking for a real estate investment property, but this is the cash that I have there waiting to be invested. These are the only reasons why I save money, and this is how I save my money. You can notice that I don't have a reason here, number 4, saving, that I save my money for my future, can't even spell right now, wealth. I don't do this. This is what so many people that I know do, especially people in the Indian culture, because we're told that if you want to become wealthy, you just need to be a heavy saver. They cut back on their expenses. They don't spend money. They save as much money as possible because they think that, hey, this is the money that I can use to live off of when I'm older. That is one of the worst things that you can do, because this money is going to consistently keep losing value day after day after day after day because of the inflation that we're seeing. The cost of living keeps going up. Life is going to be way more expensive in 30 years than it is today. You do not want to be saving your money today, riding this escalator up when the escalator is going down, when you can put this money somewhere that is going to grow in value. This is what financial education is all about. What you want to be doing with the cash is really focusing here. How can you grow your money? That way you can become wealthy. How can you take your cash and put it somewhere that is going to grow with inflation? Because the reality is we're going to continue to see inflation. We're going to continue to see money printing happen. Back when the 2008 crash happened, we saw a historic amount of money being printed, and nobody could believe that the United States government could do a $1 trillion bailout package. Well, then 2020 happened, and we put that $1 trillion figure to shame because we printed so much more money during the 2020 pandemic and into 2021, and chances are when the next market crash happens, we're going to be printing even more money. So instead of being on the defensive and then getting upset anytime this happens, you need to start playing offense, and you need to start using your money as a tool. That way when all this money printing happens, you're not the one that's now having to deal with all these higher expenses. You're the one who owns the assets that now become more valuable because dollars keep losing their value. Before I go into the different ways that you can invest your money, if you are interested in learning more about this type of financial education, we have a free guide on money management and investing that you can read for free that will walk you through some of the different financial education topics that you need to know. It'll walk you through how to manage your money. It'll walk you through how to invest your money for wealth. That way you can use your money as a tool to help you become wealthy. This guide is completely free when you sign up for a daily newsletter. So if you want to read our free guide on money management and investing, I'll put the link to how you can download it and read in the description below. The way you invest your money is going to depend on your goals. Do you need cash flow now? Or are you okay investing in something and hoping that this thing is going to be worth a whole lot more money in 10 years or 20 years? So depending on your goals, your investment strategy is going to differ. I love cash flow. That's why I love investing in real estate. And anytime I talk about investing in real estate, you get a few different pieces of criticism. First, people say, oh, that's expensive, I can't do that. Or what happens if we see another housing market crash? I don't want to invest in real estate before the market crashes. Let's start with this. If you tell yourself that you can't invest in real estate because it's too expensive, I guarantee that you'll never be able to do it. But what you can do otherwise is you can tell yourself, all right, I want to invest in real estate. How can I do it? Now your brain's going to be working to help you figure out a way to invest in real estate, because there's a lot of different ways that you can invest in real estate that don't require a ton of cash out of your pocket. And even if you need more cash, then maybe you can start looking for other ways to earn some more money. That way you have more cash to use as a down payment to start investing in real estate. If you look in the Midwestern United States, there are a ton of neighborhoods where you can go out and buy a home for less than $150,000 that you can then turn around and rent for $1,500 a month. And these are growing neighborhoods where businesses are moving into, where people want to live. If that doesn't work for you, then you could go out and buy a duplex to live in yourself. So you live in one of the sides of the duplex, and then you rent out the other side of the duplex. So you bought a home for yourself to live in, you're just renting out half of the home to somebody else. If that doesn't work for you, then you can go out and buy a home to live in yourself, and after 1 year, you can move out and let somebody else live in this property, and now they can pay you rent. And because you bought the home originally to live in yourself, and you lived there for 1 year, because most banks will require you to live in the home for 1 year before you can rent it out to somebody else, you get to keep your lower interest rate, and now you have your first rental property. If you do it right, they'll be paying your mortgage, paying all your bills, and putting some money in your pocket every single month. And if that doesn't work for you, then you can buy a home to live in yourself, and you can rent out the basement, or you can rent out one of the rooms. There's always a way to find opportunity if your mind is open to the opportunity. If you shut yourself down and you become a cynic, you become a hater, where you always say, oh, I can't do that, only you can do that, or I don't have the ability to do that, I guarantee you will never have the opportunity to become successful, because you're going to shut down every opportunity that comes your way. You can also invest in the stock market. I have money in the stock market. I invest every single week into a few different ETFs. So now now I'm getting exposure to the general market. An ETF is an exchange traded fund, and you can think of it kind of like investing in a basket full of stocks. So now instead of trying to find the perfect company to invest in, you could just invest in an ETF that gives you exposure to the entire stock market. So if the stock market goes up, your investment goes up. The stock market goes down, your investment will go down. This is an easy way for you to create a system where every week or every 2 weeks or every month, you're just going to invest a little bit of money into the market. The way for this to work and for this to build you wealth, you have to stay consistent. When the market goes up, you keep investing. When the market goes down, you keep investing. You do not want to stop this strategy, because what's been proven with this strategy time and time again is that if you want it to work, you have to stay consistent even when the market's up and even when the market's down. You can also look at investing in individual companies, whether it's on the stock market or outside of the stock market. You can invest in growth companies, startup companies that are looking to go public, that are looking to trade on the stock market or get bought out, or you can invest in individual companies on the stock market if you're willing to put in the time to research companies and analyze the numbers. This is another way that I like to invest my money. I don't get a return on my money very quickly, but I'm looking for long-term growth here by investing in companies that I believe in, that have a good product for the long term. There are so many different ways for you to invest your money, and now thanks to the internet, it has become more accessible than ever for anybody to start investing your money, because now you can invest your money on virtually any asset class for less than $100. The thing that you have to remember is that our dollars are now liabilities. Our cash is losing value because as more and more money is printed, the value of each dollar that we have goes down. And you're going to see fluctuations in dollar value. Sometimes it'll go up, sometimes it'll go down. But over the long term, we've seen the dollar lose 96% of its value from 1913 until now. And we saw the dollar lose 85% of its value between 1971 and now. And you can expect that over the next few decades, you're going to continue to see that trend continue downwards. So as the dollar loses value, you need to own the assets that will appreciate in value as the dollar keeps going down. This is what financial education is all about. If you enjoyed what you saw so far, then you're gonna love this. There used to be a time where saving your money in the bank was a good investment because banks would actually pay you a decent amount of interest on the money you were saving. Now, that's not the case. In the early 1980s, you could take your extra cash and put it in your bank CD, and you were guaranteed to get 10% a year on your money. In the 1990s, you could get 5 or 6% a year on your savings. Still not bad. In the early 2000s, you could still get a guaranteed 2 to 3% a year from the bank. Nowadays, you're lucky if you could get 0.1% in interest a year, because most banks are paying 0.01% a year in interest, which essentially means your bank is paying you nothing for your savings. At the time we recorded this video, Chase Bank is paying out 0.01% a year, Wells Fargo is paying out 0.01% a year, and Bank of America is paying out 0.01% a year. The whole reason people were always told to save their money in the bank was for 2 reasons. First, you got security, because when you put your money in the bank, you knew where your money was, and second, you would get some interest on your money, because if you just kept your cash in your sock drawer, well, now your cash isn't growing, it's just sitting there. Now, your cash in the bank is not growing. It's just sitting there, but you still get the security with the bank. Now, this is a really strange situation because banks used to incentivize people to save their money in the bank through their interest rates. Because the way that banks work is when you deposit your money in the bank's gonna give you a receipt saying that you have $2,000 in the bank or whatever money you deposited. And then the bank is gonna take this money that you deposited and they're gonna turn around and they're gonna lend it out to somebody else. And then they're gonna collect interest on the money that they lend out. And they're gonna use this interest as their profits. And so now when you put your money in the bank's gonna pay you nothing, but they're still gonna turn around and they're gonna lend this money out for 4% or 5% or 15% a year in interest, depending on what kind of money they lend out, whether it's a mortgage or whether it's credit card debt. And so the bank is still gonna lend this money out, they're gonna rake in the fat profits, and now they're gonna pay you nothing. Now, I don't want you to be that person that makes financial decisions based off of what someone else is getting, because somebody else can make a profit and you can get some benefit. There's nothing wrong with that. I have no problem if somebody makes a profit off of me as long as I'm getting some value. But here's the situation that we're in right now. We are right now in a system where our society, including banks, profit when people are not financially educated. I'll show you what I mean. If you go out and you save your money at Wells Fargo, Chase Bank, or Bank of America, they're gonna pay you nothing. They're gonna pay you 0.01% a year on your savings. But if you took that same money and now instead of saving your money at the bank, you use this money to invest in the bank, you'd be getting a much different return. because now if you are an investor, you can invest into these companies because all three of these banks are public companies, meaning you can invest into these three banks on the stock market. So now if you go out and you invest in Wells Fargo or Chase or Bank of America, you're using your money to invest in these companies, meaning you become one of the owners of these companies. Well, if you become one of the owners of these companies, you're going to get a much better return than you would if you just saved your money at the bank. If you went out and you invested your money at the Wells Fargo Corporation, meaning you go out and you buy shares of Wells Fargo, they're going to pay you an annual dividend of right around 1% a year at the time when we're recording this video. This is just the dividend, meaning every single year, Wells Fargo is going to send you a 1% return check in the mail or deposit this money into your account every single year just for investing in the company. Chase Bank is going to pay you right around 2.5% a year in dividends, and Bank of America is paying out at the time we're recording this video right around 2.25% a year in dividends. Meaning, if you go out and you invest in these corporations, in these banks, you're going to get a much better return on your money than you would if you just saved your money at the bank. What this means is that Wells Fargo is rewarding their investors with a 100 times better return than they are the people that are saving their money at Wells Fargo. And Chase Bank is rewarding their investors 250 times better than the people that are saving their money at Chase Bank. And Bank of America is rewarding their investors 225 times better than the people that are just saving their money at Bank of America. This is why financial education is so important, because the people that are getting rewarded are the investors, not the savers. This is where you have to understand why saving is important, when you should be saving your money, and how to save your money the right way. Back in the day, saving was a way for you to build wealth because now you could save your money in the bank, earn a decent return, and when it came time for you to retire, you can rely on your savings, plus you'd have Social Security and a pension to fall back on. Nowadays, that is not the case. So if you talk about saving money, you have to know how to save your money the right way based off of this time and this generation that we're living in right now, because things have changed. Saving your money is good for 3 reasons and 3 reasons only. Saving your money is good if you're saving your money for an emergency, or if you're saving your money for a big purchase, or if you're saving your money for an investment. If you're saving your money for one of these 3 reasons, you are saving your money the right way. But if you're saving your money just to save it, or if you're saving your money for a reason that does not fall into these 3 things, then you are losing by saving your money, because I just showed you the whiteboard. You are losing by saving money. You have to have cash for emergencies because sometimes life happens and you want to make sure you have easy access to that, and the easiest place to access this money is in the bank. So you want to make sure you have a savings account and a checkings account, and in the savings account you want to make sure you have cash for emergencies, and you want to start with a minimum of $2,000. If you don't have $2,000 saved up, you are in financial danger, and the very first thing you got to do before you go on to spend any more money or do anything else is you got to save $2,000. After you do that, you want to make a goal of saving somewhere between 3 months and 12 months worth of expenses in the bank. That way, now you have cash to fall back on in case you lose your job or in case an emergency happens. Once you have that savings cushion filled, now you don't want to just keep saving money to save it, because now your savings are losing. This is where you got to start using your money the right way. The second reason why you want to save money is to save money for a big purchase. So if you want to go out and buy a car, you want to buy a home, you want to go out and upgrade your wardrobe, you want to go on a nice vacation, all these things require money, and you want to make sure you have cash to afford these things, because all these things are liabilities, meaning they don't put any money in your pocket. So if you're buying something that's not going to make you money, you want to make sure you have the cash to afford it, and the best way to have that cash is to save that cash. This is not money that you want to be using from your savings account for emergencies. This is separate. So when we talk about using your money to buy things, you want to make sure you have cash for that, and that is another good reason to save your money. The third reason why you should be saving your money is to save your money to invest your money, because sometimes people feel that, oh my God, yes, saving is losing, and so I need to immediately invest my money every single day. But that's not necessarily the case. If you're waiting for a good investment opportunity, maybe you're looking for a good stock to invest in, or maybe you're looking for a good real estate investment deal, you don't have to always have this money invested. Cash is an investment position too, and if you're waiting for the right investment, that's okay. You can have cash aside waiting to be invested, and that's okay, because sometimes you need to just wait for the right investment. Beyond these 3 things, you don't want to just keep saving your money to save it. And I know this can be hard for some of us to think, because when you have a big bank account, you just feel safe and you feel secure because you have a lot of cash in the bank. But the reality is, this cash in the bank that you have just stacked there, it is losing value to inflation every single day. It is getting eaten away by inflation. And so you want to make sure you keep growing this money money instead of just having this money sitting there eaten alive. I grew up in a traditional Indian house, and the traditional Indian culture is a save heavy culture. Traditionally, Indian people are really scared of risk. They don't like to invest their money, and so that's how I was raised. I never learned about investing. I never learned about how to use my money the right way. The only thing that I was told is I need to save as much money as possible. But the reality is that system doesn't work anymore, because if you're just constantly just saving all of your money, well, your money might be stacking up, but that money is not growing in value because life, everything around us keeps getting more and more expensive faster than your money in the bank, because your money in the bank is just sitting there flat. It is not growing, it's not doing anything, it's just dead. So your savings account is not growing while the price of everything else around you keeps getting more and more expensive. So what you want to do is, after you get this emergency fund filled up, you want to make sure you're using your money to grow into something that's going to make you more money. This is where you got to understand that your savings are not there to make you wealthy. Your savings are there to protect you from a financial emergency, but they are not there to make you wealthy. If you want to become wealthy, you have to invest your money and do something else with your money that's going to actually make you wealthy, but that's not going to be saving. Now, the next steps might seem simple. If banks are paying you next to nothing to save your money, you might as well just invest your money in the bank, because if Wells Fargo, Chase, and Bank of America are paying you 0.01%, might as well just invest your money in Wells Fargo, Chase, and Bank of America, because now you can make dividends of somewhere between 1 and 2.5% a year. Problem solved. Well, not exactly, because this is where you have to factor in risk into the equation, because when you invest your money into Wells Fargo or Chase or Bank of America, you are also taking on risk, because now there's a chance that your investment is going to fall. There's a chance that Wells Fargo is going to screw up. There's a chance that Chase is going to get sued. There's a chance that Bank of America is going to fail. And so now, if any of these three things happen, your investment value will go down and you might not keep getting these dividends. So yeah, while you can make more returns on your dividends right now, it does come with more risk. But when you invest your money, you have to factor in your risk, and you have to know what risk is good for you. The most popular ways for you to invest your money are through stocks and real estate. When you invest in stocks, now you're investing in individual companies, like we just talked about with the banks. You are getting ownership into individual companies and corporations, and as these companies and corporations make big profits, you get a share of your profits. And with real estate, what you're doing, you're buying physical properties, and then you're going to rent out these properties to people that live there or to businesses that want to use your property, and then they're going to pay you rent every single month, so it creates cash flow. Now, both of these have multiple different investing strategies within them. Like within the stock market, you can be a day trader, you can be an active fundamental investor, kind of like Warren Buffett, or you can be a completely passive investor. With real estate, you have people that are real estate flippers. These are people that are buying homes and then fixing them up, rehabbing them, and then selling them. And then you have people that are buy and hold. These are people that are buying homes and then renting them out for a long time. And then you have people that are buying apartment complexes, or they're buying shopping plazas. So there's a lot of different ways to do both of these type of investments, and you got to figure out what's right for you. Let's talk a little bit more about the stock market first. So I am not a trader. I like to just use my money as a tool to go out and work to attract me more money. So I like to just invest my money, and I want to be as passive as possible. Within the stock market, as an investor, and when I say investor, I mean somebody that's owning their investments for a year or more. There's a couple ways to do that. You have the active way, and then you have the passive way, and this is as an investor. So Warren Buffett is a long-term investor. When he finds a company that he likes, he's going to invest in it and he's going to own it forever. And he is still on the active side. On the flip side, you have passive investors. These are people that may not want to do a ton of research or want to spend a bunch of time trying to find the best companies or keep up with companies. These are people that just want to get the returns of the stock market without putting in all the work into the stock market. So personally, I do both of these things. I have some money aside in an investment account that I use for active investing. And again, when I say active investing, I don't mean trying to go and trade stocks. I mean trying to find undervalued companies. So when I find a company that I like, I will go out and buy it if I think it's a good price. I also have money going into my passive investments. Every single week, I have money that's automatically withdrawn from my checking account, and this money goes into my investment portfolio and is split up amongst a few different ETFs. An ETF is an exchange traded fund, and you can think of a fund kind of like a basket of stocks. It gives you exposure to a whole bunch of stocks and the stock market in general. That way you don't have to worry about trying to find the perfect stock. So what I'm doing here is every single week, I just keep throwing some more money into the market. That way I can build up my portfolio and I can just keep padding these investments. The great great thing about being alive and investing in today's generation is now you can invest in the stock market very easily thanks to the internet, because there are now apps that allow you to passively invest your money very simply. There's a whole bunch of them out there, so you can find the best one for you. I use something called M1 Finance. It's also a sponsor of Minority Mindset. I want to make sure I put that out there. And the way it works is you can set your own cadence where money gets automatically withdrawn from your account, whether it's every week or every month or whatever you want. So you can set your own cadence. You can decide how much money you want withdrawn from your account, and you can create this pie. So a pie is your investment portfolio. You can tell them that, hey, I want these 4 ETFs or these 4 stocks, and then anytime money is withdrawn and invested from my account, I want it to be invested into these funds 25, 25, 25, 25%. You can choose this percentage on whatever ETFs or stocks that you want. So you can create this pie, and now your money will automatically be invested into this pie and whatever cadence you decide. I like it because it's easy and it's completely passive, and this allows money to constantly be invested into the account. That way now you can have your money in the market, and you don't have to spend a bunch of time doing this because it's completely passive. If you do want to learn more about how M1 Finance works, how to create a pie, and the different investment strategies, because you can do this completely free on their app, I got the link to how you can learn more and get started investing with M1 Finance in the description below. If you want to be more of an active investor, then what you want to be doing is you want to be looking for deals. You want to find an undervalued company that you can own forever or for a long time, because now you believe that this company is undervalued. You believe in who the executives are. You believe in the way they're running the company. You believe in the products, and you believe that this company is going to be more valuable in the future than it is now. If you find a company that you believe in, now you can take your money and you can invest in it, but now you also got to stay up to date on this company. You got to stay up to date on the earnings calls. You got to stay up to date on the products. You got to stay up to date on who is running the company, because if something major changes and this company starts to tank, you want to make sure that you do something about it, because if this company is about to go under, you want to sell the stock and get your cash out before you lose all of your money. And so now you have to pay attention to your investment, and this takes time. So if you want to invest your money in the stock market, you have to decide, are you this type of person or this type of person, or both? I like to do both, and you just got to figure out where you want to be. With real estate, you're doing things a little bit different, because now you're buying properties, you're buying physical real estate, and now your goal is to rent it out. Now, you can be a flipper in real estate, but I don't like to consider that as an investor, because when you are a real estate flipper, you're buying a property, you're fixing it up, and you're selling it as fast as possible. So you're actively involved in the deal, and you're trying to sell it as fast as possible instead of trying to invest your money for the long term. So when you're investing your money in real estate, your goal here is cash flow. You want to buy a property, you want to rent it out, and you want this property now to pay for your taxes, your insurance, your maintenance, your management fees, and your vacancy cost, and then put some money in your pocket every single month. So I like real estate because now you can create a passive stream of income, because now if you have a good management company, they're going to handle all the day-to-day work, and if you do it correctly, it is going to pay you every single month with this type of cash flow, because now you own assets that are producing cash, because once you own a property, you own it, and it will continue to pay you month after month after month, because people will continue living in or using your property. The downfall with investing in real estate is now it requires way more work, because now you have to find real estate agents, you have to find property contractors, property inspectors, you have to deal with attorneys and accountants and tenants. So there's a lot more physical work involved, because now you're going to have to go out and find the right property, you're going to have to negotiate the deal, and then you're going to have to make sure it gets rented out. After that, then you can hand it off to a property management company, but there is more work involved, and there's a big learning curve, because everybody talks about how real estate investing is super passive and it's super easy. All you have to do is find a good property. But I have been investing in real estate for about a decade now, and it took me a few years to really understand how real estate investing works and to really understand how to make it passive, because there's a huge learning curve that you have to get through, and that takes a lot of time and it takes a lot of stress, and you have to go through your own fair share of headaches. Once you get past that initial learning curve, then real estate can be very lucrative, because now you have just created a new income stream that will pay you forever as long as you own this property. So now what you have to do as a financially educated person is you have to figure out, okay, what is the best way for me to use my money? We already talked about saving. Saving your money is important as long as you're saving your money the right way, but after you save your money the right way, you have to make sure you're using your money smartly. And now you have to decide where you want to be. Do you want to be investing your money in stocks? If so, would you rather be investing here, or both? Or do you want to start in real estate and focus here and figure out kind of where in the real estate world do you want to be? Now, you can do both of these things, but there's only so much you can do at one time. And so it's much better for you to start with one and then move on to the next and the next. Once you can kind of master one, it's a lot easier for you to go on to the next one. So this is where you have to decide, what is your goal as an investor? Do you want to see this type of cash flow? Because yeah, you can get that cash flow in stocks with dividends, but it's a little bit easier with real estate because now you can predict and create this cash flow through your rental income, at least from my experience. With dividends, yeah, you can create cash flow, but you don't get the same returns that you do in real estate. The whole idea behind all of this is now for you to get a better return than what you're getting at the bank, because right now your savings accounts are paying you nothing. And so it is more important than ever for you to get financially educated and for you to get financially smart and for you to use your money the right way. That way you can build your own wealth, because the system and banks are not going to help you do that. Thank you for watching. If you enjoyed this video, here's a video on how the system keeps so many people poor that I think you'll love. And while you're at it, download our free guide on money management and investing. And as always, keep hustling. The first sign you're fake rich is you are paying $500 a month for your brand new car, but you don't got $500 put aside for your investments.